So next we're going to talk about the effective interest method when we're dealing with premium bonds. The first part of this lecture is the same lecture that we used for the discount bonds, but I'm just going to go back over it before we go through an example of a premium bond. Again, just as a reminder, there's some implications from the straight line method. The first lecture covered total interest expense when there's a discount, and we see that the total interest expense is the sum of the total interest payments and the discount balance. That's both in total, and then every single period, the interest expense is the sum of the contractual interest payment and the amortization of the discount. The same, or it's similar for premiums, except for in this case the total interest expense is the difference between the total interest payments and the premium. And then with every single payment, the expense is the difference between the contractual interest payment and the amortization of the premium. And so when we're dealing with the effective interest method, it's important to note that the total interest paid and the total interest expense is exactly the same as what we had with the straight line method, because the contract for the interest payments doesn't change and the price that we receive also does not change. And we can see through those identities above, that means that the expense will also in total be the same. However, because the amortization is going to be different, in other words, the way that we deal with the discount and premium on a period-to-period basis is going to be different. That means the interest expense will be a little bit different every period. Total is equal, but the amount every period will be different. And so I want to be clear that the reason they're different is because the way that we're going to amortize the premium or discount is different. And so the effective interest and straight line methods apply to the way we amortize the discount or premium. That's what we're dealing with. And so the big difference again with the effective interest method is that you actually have to solve for the bond yield, whereas under the straight line method you didn't actually have to do that. Okay, so now we're going to walk through an example. Panther Company issues a $350,000 in 3-year semi-annual 7% bonds on May 1st, 2018. The interest payment dates are April 30th and October 31st, and the bonds are issued at 103. And so we're going to do the journal entries for 2018, for April 30th, 2019, and also the bond maturity date of April 30th, 2021. And we'll have the company's fiscal year end on December 31st. So the first thing we have to do is figure out, well, what's the issue price, the cash proceeds? And so of course we apply the price of 103 to the par value and we get a price of $360,000. So the initial journal entry is pretty straightforward. On May 1st, 2018, the cash that we receive is $360,500. That's the debit. The bonds payable have a par value of $350,000. So that's the amount of the credit for the bonds payable. The difference, of course, is a premium on bonds payable. The next step is to figure out how we're going to amortize that bond premium. And so part of the way we're going to do that, again, is we have to work through the amortization table. And so we know, first of all, that each interest payment is semi-annual. So we take that 7% annual rate and we divide it by 2. And so we see that semi-annual payments are 3.5% of the par value, which is $12,250. Once we have the interest payment, then we can use that information to solve for the bond yield. And again, because we're using the effective interest method, we need that bond yield in order to create the amortization table. And so in this case, our N is 3 years or 6 semi-annual periods. And so our N is 6. The PV is the issue price of $360,500. The payment is the contractual interest payment of $12,250. And of course, the future value is the par value of $350,000. We use this information then to solve for the yield. You can see that the semi-annual yield is 2.9472%. And as we would expect, because this is a premium bond, we would expect that the contractual rate is more than the yield. And we can see the contractual rate semi-annually is 3.5%, and the bond yield is 2.9472%. And so we can see that, as we would expect, the contractual payment rate is greater than the bond yield. Alright, so now we're going to use this information just like we did before to create an amortization table. The only difference here, of course, is that we're dealing with a premium bond instead of a discount bond. The initial issuance is on May 1st, 2018, and the initial carrying value is $360,000. Now I want to be clear here, the amortization table is built around the semi-annual payment dates. And so the first semi-annual payment is October 31st, 2018. And we can see the second column is a contractual interest payment of $12,250. The interest expense is sort of the economics of what's occurred. And so as we see above, the bond yield is what gives us the market rate, and we apply that to the carrying value of $360,500 for an interest expense of $10,625. The amortization is the difference between the expense and the interest payment. In this case, we can see that amortization is negative, meaning that over time, the carrying value is going to go down. And so economically speaking, again, I just want to clarify, the contractual interest payment is fixed at $12,250. But from an economic perspective, we've incurred an interest expense of only $10,625. And so we're paying not only the economic interest that we've incurred, but we're also making an additional payment. And so conceptually speaking, we're paying down the amount, the liability or the carrying value of the bond payable. And so that's why we have a reduction in the carrying value over time. And that continues with every contractual interest payment until finally the carrying value arrives at the par value when the bond matures. So now we're going to create the first journal entry for the first payment. And so we're using the 10/31/2018 line in the amortization table. And we can see that we have the cash payment of $12,250, the amortization of the bond premium of $1,625. But remember, the premium balance is a credit balance, and so amortization is going to be a debit to that account. Interest expense then is derived as the difference between the two. Now the next journal entry is a little bit more difficult, which is why I have dotted lines around April 30th, 2019. And the issue with this line in the amortization table is that a portion of it occurs in fiscal year 2018 and a portion of it occurs in fiscal year 2019. And so we have an issue at the fiscal year end where we must accrue the interest. And so there are two portions of the interest that must accrue. First, there's the contractual interest payment. The payment is $12,250. We have to accrue November and December, or 2/6 of that payment, for a total of $4,083. From an economic perspective, we have to accrue the interest expense, but again, the basis for that amount is different. It's only $10,577, and so we apply the same 2/6 to the interest expense, and we get the amount that should be accrued in 2018 at the firm's fiscal year end. And so that amount is $3,526. And so then our journal entry is the interest payable, which is the accrued interest payment of $4,083. We have to accrue the interest expense, as we calculated before, $3,526, and the difference is the partial amortization of the bond premium. And so that $1,673 is the total amortization over 6 months. This entry captures 2 months of amortization of the premium. And then on April 30th, 2019, we actually make the payment. And so there's a remaining interest expense. The total was $10,577. We previously accrued $3,526, and so now we have to record the remaining interest expense of $7,051. So then our entry, when we make the cash payment of $12,250, a portion of it goes towards basically paying off the previous interest that we had accrued as a payable, the new interest expense, and then the difference is the remaining amortization of the premium on bonds payable. And of course, we would continue that process over time, recording payments, accruing at the fiscal year end, and then recording the April payment until finally we would come to the end of the bond. And so we're going to kind of walk through that final journal entry and see if we can conceptualize what that final journal entry would look like. So first of all, we have to understand that we would have previously accrued interest on December 31st, 2020. The nice thing is, because the interest payment is constant, the amount of interest that we accrue as a payable is also constant, $4,083. However, the interest expense that needs to be recorded on April 30th, 2021 is going to be different because the interest expense is different. And so we can see that between January, February, March, and April 2021, we have to accrue 4 months out of 6 months of interest expense from that last line in the amortization table for a total of $6,914. So we take that information and put it into our journal entry. We can see again we're taking the payable off of our books, $4,083. The new interest expense of $6,914, and of course the bond payable is coming off our books at maturity, so that's going to be debited for $350,000. The final cash payment is not only the $12,250 interest payment, but also the repayment of the par value of $350,000 for a total of $362,250. And so the last little bit, which accounts for the difference, is the premium on bonds payable is now completely amortized, and the balance in that account would be 0.